The Singapore real estate market was largely subdued during the first 3 to 4 months of 2016. On the investment side, activity slowed sharply in Q1 this year, especially in the commercial and industrial sectors, while residential activities was firmer. Total investment volumes dropped 41% to 2.4 billion in Q1, compared to the 4.1 billion transacted same time last year. Main reasons for the decline were due to the lack of mega deals in commercial property and a general cautious sentiment in the industrial sector. Nonetheless, we continue to see a healthy stream of institutional interest in the Singapore commercial property market. Prime developments in Singapore are still drawing a solid level of inbound investment interest. For the leasing market, we can sum it up in 3 trends. Firstly, occupiers remain generally cost-conscious, and we're still focusing on reducing cost across the board in the face of economic and business uncertainties. The unfavorable business operating environment also led tenants to stay rental sensitive when evaluating their real estate requirements. Secondly, tenant retention and attraction were key priorities for landlords in Q1. With softer occupier demand and new supply coming up, landlords of older buildings and assets are keen to build on an attract and retain approach by developing incentives and attractive rates to retain existing tenants to maintain occupancy. Apart from being more proactive and reaching out to existing tenants, especially those with leases expiring in the next 6 to 9 months, landlords will also seem to be less selective and more willing to consider offers and negotiate terms to fill vacancies. Thirdly, we continue to see rental values experiencing downward pressure. Some occupiers who were looking to upgrade to more efficient and cost-effective space are taking the view that the current climate presents an opportunity to enter into lease negotiations early to obtain favorable rates and terms. The market presents opportunities for occupiers to trade up their space into locations previously deemed too expensive. In the office sector, after experiencing some 3.8% drop for the whole of 2015, rents for premium and Grade A office space in the CBD continued on a downward trend, seeing a 3.6% decline in Q1. This is due to competition from new buildings in both the CBD and non-CBD locations. Similarly, in the industrial sector, rents for prime multi-user conventional industrial space softened during Q1. The average monthly gross rent for ground floor space dropped about 6% quarter-on-quarter. On the other hand, rents for high-spec industrial space showed a greater resistance because space availability was tight. Our basket showed that the average monthly gross rent for ground-level high-spec space in D showed a marginal increase of 1.5% quarter-on-quarter. In terms of retail rents, the average monthly gross rent for prime ground floor retail space in Orchard Road saw a marginal quarter-on-quarter drop of 0.6% during Q1. On the other hand, the more resilient regional centres were also affected by the tough leasing market and saw a drop of 0.5% over the first quarter, although rents in the regional centres were generally more resilient than those in Orchard Road, which has a higher dependency on tourist traffic. The Singapore property market will present selective opportunities to purchase well-positioned assets in strong locations at a discount in the short term. We anticipate investment activity in the next few quarters to gradually pick up as investment demand for core products will remain firm. Therefore, we forecast total investment volume for 2016 as a whole to be around $15 to $18 billion compared to the $20 billion in 2015. We all know that the property market is cyclical. Therefore, any property markets will not remain depressed indefinitely, or any price appreciation will not go unabated forever. The current price weakness may therefore present buying opportunities for investors. This window of opportunity, though, may be relatively short. Investors and occupiers alike have to be nimble to be able to benefit before the market turns. Looking forward, what really matters are the future demand and supply forces shaping the occupier market across all sectors. For instance, a combination of oversupply and changing corporate requirements for office space will add pressure on the occupancy and rental levels. We expect office rents across the market to drop by 3 to 5% per quarter until the second half of 2017. We will see demand coming from a broader range of diverse sectors such as technology, media, and professional services. Occupiers' flight to quality, resizing, and relocation to new space will continue to play a part in the leasing market, and we expect this trend to continue well into 2017.